Welcome to this Killik Explains finance video. This week, a tax-effective savings wrapper for small company investors called the Enterprise Investment Scheme. Who's it suitable for? How does it work? What are the pros and cons? Well, here's the basic deal. You agree to tie up your money in small, higher-risk companies for a decent period of time, and in return, the government incentivises you with some pretty decent tax breaks. So you could get tax relief from the government and hopefully, if those companies are chosen carefully, some decent growth on top. But this isn't for everybody. Why not? We'll see the types of companies that qualify for the scheme in a moment, but from your point of view, you might be someone who's already used up their ISA allowance. You might be somebody who's also used up their annual pension allowance and is looking around for a tax shelter, but is also comfortable locking up your money and taking some investment risk. Now, we're going to suggest a minimum 5-year period as a lockup and somebody who's comfortable with higher levels of investment risk. These are small, fast-growing companies. So what type of company would be within this tax wrapper, and then what are the tax breaks? Well, what are you buying? You're buying qualifying firms, as they're called. There are tight criteria. 1, this is a firm that's not listed on a main market like the London Stock Exchange. 2, the gross assets do not exceed 15 million, so it's pretty small. And 3, probably a given at that point, it has fewer than 250 full-time employees. So these are small, fast-growing companies, probably not listed on a main exchange, probably not even listed on something like an alternative investment market in most cases. Now, to bring you in, income tax breaks are hefty on this one. Up to 30% of the cost of the investment can be set against your income tax liability, and that applies in the year of the investment and or the previous one. 30% is pretty meaty. We'll look at the effect of that in a moment. And the maximum, because obviously the sky could be the limit, is £300,000 based on a £1 million investment. And just note, you must hold the shares for at least 3 years or that relief is potentially lost. But then again, this is an investment that is suited to at least a 5-year time horizon given the type of company you're investing in. Now, you must also not be connected to the company. So if you're a director of a company, you can't claim EIS relief on your own shares, as it were. Not the only break available, the CGT breaks are generous too. So we've got shares on which income tax relief has already been given, held for a minimum of 3 years, can be sold free of CGT. If you're wondering what that looks like, snapshot coming up. And if shares are sold at a loss, the loss can be offset against income tax in the year of the gain or the previous one. And you'll see the benefit of that in just a moment. But watch out, there's a third benefit here too, which some people miss. That stuff on the right-hand side applies to, if you like, EIS investments themselves. This one over here applies to general investments. So if you make CGT on disposing other assets, if you incur capital gains on other assets, you're hit with tax, you can defer that by rolling into an enterprise investment scheme. So in other words, other assets potentially can have their capital gains tax liability deferred at least by rolling the gain into an EIS. So quite a few capital gains tax reliefs to think about. Here's Mr. Jones. So he pays income tax at a marginal rate of 45%. He's likely to be an additional rate taxpayer for this to be appropriate. He invests £50,000 in an EIS for the full 3 years. 3 scenarios. The firm's value doubles. So he gets the income tax relief. That's 30% at 50,000. In the year he makes the investment, 15,000. His CGT is 0, we said, CGT free, and therefore his potential gain is £65,000. The capital gain with no tax on it and the income tax relief. Pretty handy. But even if the firm's value stays static, he still gets the income tax relief, so that's a gain as well. And if the worst case scenario happens, here's the loss relief coming in, the firm collapses, he still gets the income tax relief in the year he makes the investment, and on top of that, he can expect loss relief of £35,000, 50 minus 15, at his marginal income tax rate of 45%, or 15,750, which means, in effect, his overall loss is reduced to just 19,250, even though the underlying firm's collapsed. So quite a nice shelter there, potentially. Now, on IHT, possibly 100% relief if the investment is held for at least 2 years. Well, we're suggesting these should be held for at least 5 years, and the shares must be held at the time of your death in order for the relief to apply, which would potentially remove them, if you like, from your death estate. So there you have it. Quite a neat wrapper, summarised there as a way of getting an investment into small, fast-growing companies and attracting income tax, capital gains tax, and even some inheritance tax relief. But it's not for everybody. These are high-risk investments, so think carefully before committing your capital. Any questions? Editor@killik.com.